Okay, everyone, welcome to Module 10, Should You Refinance Your Mortgage in the Rich Mama Secrets course. So we're going to talk to you about the possibility, or if it's a good idea to refinance your mortgage. Why would you want to do that? Refinancing a mortgage would be so you can get a mortgage with a lower interest rate or lower monthly payments that can save you thousands of dollars. So what is refinancing your mortgage all about? It's about paying off a loan or loans you currently have and taking on a new mortgage loan. Your current loan gets paid off in the refinance when you close out the new loans. It's usually easier to refinance a mortgage than it is to get the mortgage loan in the first place because the banks like the fact that you have a payment record, you already shown you can afford the house. But sometimes it does cost you some money in terms of some fees. Okay, so equity. You've probably heard that. Equity is the current value of the home minus what you still owe on it. So that's the equity. So that's the amount you've built up in it. So the equity comes from two ways. It comes from the money you've actually put down on the home, the amount you've paid off on the loan, and also any net equity that's built up because of the way the market has risen. So if you bought your home for $250,000 and the value of homes have risen by about $50,000, your home is now worth $300,000. So if you put down $50,000 in your house to begin with, you only owe $200,000. Well, now the house is worth $300,000, so you gain an extra $50,000 worth of equity just by the value of the home going up. And nothing happened. You didn't put any more money in, any more done. You got to take advantage of the rising home market. It also works in reverse. If you bought a $250,000 house and it's now worth $200,000, your equity has been decreased by $50,000 in it. So it works both ways. Equity is what gives you all kinds of choices in refinancing your home. So this is anytime your equity is enough so that you're financing less than 70% of the home's value, you're going to find lenders eager to compete for your business. Sometimes we do what's called cashing out your equity. This is when you receive cash along with your refinance. So this is when you take some of the money either you've put in paying down your mortgage or some of the value of the home as it's risen along with the market and take the cash. Sometimes people will do that to take that cash out, paying off all your current debts, like your credit cards debts, and starting over with new mortgage payments. It can build great credit, but again, I also feel it's a little bit of a symptom of the problem. You've just taken money from one place, paid off the credit card debt, and you haven't really figured out how you and your family are going to live without building up more credit card debt. You haven't done the work, the exercise. It's like kind of taking a secret pill that gets rid of all the extra flab, but you haven't really learned the good habits of eating and nutrition and exercise. But why should you consider refinancing your mortgage? You can lower your monthly payments, you can lower your interest rate, and you can change from a variable interest rate mortgage to a fixed interest rate. Variable rates are ones that go up over at a certain point of time, especially if interest rates go up. Maybe you got your mortgage when interest rates were about 5%. Interest rates slowly go up. At some point, your mortgage will reset to the more current interest rate, and your payment's going to go up. This can be a bit of a shock, so you might want to do a fixed interest rate mortgage where you know exactly what the payments are going to be for the life of the loan. You can always cash out on some of your equity. You can use that cash to pay off higher interest debts. You can pay cash for a major purchase instead of taking out a higher interest loan. And you can also consolidate your debts by cashing out, so you have one monthly payment instead of many. By refinancing your mortgage, you can raise your credit score. You can receive some income tax deductions. So in the USA, if you itemize your deductions on Schedule A, you can deduct interest payments on your home's mortgage from your income. But credit card interest isn't deductible, which means that by using your equity to pay off your credit cards and putting that debt into your home mortgage, you've lowered the interest rate you pay on your credit card debt while at the same time making it tax deductible. So that's kind of a little advanced. I think also our primary focus as families should be on getting out of debt and staying out of debt, not necessarily playing these games for all these different nuances of better interest rates and things like that. But what's bad about refinancing your mortgage? When you're starting over in your mortgage, it may take you longer to pay it off than you had not refinanced. So if you're 15 years into paying off your 30-year mortgage, you refinance with a new 30-year loan, guess what? You're going to be a lot older by the time you pay off that house. Your mortgage debt would be larger than before the refinancing, maybe due to some closing costs and if you take out some cash. So you might have some early payoff penalties if you wish to pay off your mortgage in the near future. And this would happen, say, if you sold the house, for instance, and you had to sell the house sooner than you expected. Well, how to get started? You can see a mortgage broker to help you find a lender. You can look at your bank. You can check out online. You can also modify your current mortgage loan. So if the value of your home has decreased, consider modifying your mortgage loan. You may be able to lower the interest rate, your monthly payments, or even the principal in the loan by modifying it. But it can be challenging, so be prepared to hear no a lot, or to keep trying and be creative here. You want to contact your lender to apply for the loan modification, and you want to keep in regular contact with them and by phone and fax, and keep a note of all the times you talk to them. You also want to make sure that modifying is not going to have any impact on your credit. You want to record the phone calls, record any emails. You just need to keep really good records with this. With good communication and how the process can go, your loan modification can be a success. Again, you just want to understand any impacts to your credit history and credit report if you did go this route. So, do you have a fixed or adjustable rate mortgage? In that case, if you have an adjustable rate mortgage, you might definitely want to look into refinancing. Is the new rate low enough to justify the switch? So you want to make sure that you're actually going to be saving money, because it does cost some money to refinance. So you want to make sure that you're saving enough money with a lower interest rate to pay for all these closing costs. How much equity do I have in my home? If you are at a negative equity because the market's gone down, refinancing might not be a good idea. If you are at market, or you have gained some equity because of the market, it might be a good idea. You want to ask how long it's going to take you to pay off the cost of refinancing and realizing your savings. So that's what we talked about before. It costs some money to refinance, so make sure that the interest rate change, or interest rate, is really going to save you enough money in the long term or the short term to make it worth refinancing. You also want to say, am I going to stay in this house for a long time, or will I be moving soon? If you're going to be moving soon, refinancing may not be right for you, but if you plan on staying in the house, refinancing and saving that money over the long term can be great. What are you looking for? Lower interest rate, lower payments, or cashing out your equity? Just again, be careful cashing out your equity, because at the end of the day, you're going to owe more than you did before. You're going to increase your debt instead of really decreasing it. If you cash out your equity to pay off other debts, do you have the discipline to stay out of debt once your current debts are paid? What will you do with your credit cards? So just be really careful about cashing out equity, refinancing to get equity out of the house to pay off other debts. Be really careful. Make sure that you understand that you've taken the time to pay off your credit cards, taken the time to modify, to build a budget, to understand what got you in debt in the first place, and change those habits. Alright, so good luck. We'll talk to you next time.